Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, welcome. This is Todd Taskey. I'm the host of the Second Bite Podcast, where we talk with top CEOs and entrepreneurs about how to create valuable companies. And today, I've got Jeremy Weiss with me, who is CEO of Rise 25 and has done countless interviews with CEOs and entrepreneurs. And today we're going to flip the script and let him kind of drive the bus and ask questions of me. Jeremy,
Todd,
glad to have you.
Thanks for having me. Todd, I'm super excited, and because everyone eventually really wants to have a great outcome and exit for their company. This is what you help companies do. So we're going to walk through everything that you do for a specific company and what happened. And before we get to that, this episode is brought to you by Potomac Business Capital. And I know, Todd, you help businesses in the lower middle market maximize their value. That's what you do. People come to you and go, Todd, I want to sell my company for the maximum value. Help me. And that's where you take them through all the twists and turns of the baking process and any questions that they have. So both companies come out the other side with a win. You've been doing it for over 15 years, and you've really helped perfect the strategies for M&A advising and exit planning to guide your clients through that. So if people have questions, Todd, I know they can email you, Todd at PotomacBusinessCapital.com, or go to your website, PotomacBusinessCapital.com. We're going to start with, there's a company that is specifically a performance marketing company. And I want to start from the beginning here. First of all, how did you connect with this company?
Yeah, so good question. And to clarify, you're absolutely right that we help clients with exit. We help clients when they've been working for a long time and they don't want to work anymore. They want to do something different, and they just want to, they want to move on. But a lot of the transactions that we do are transactions where the entrepreneur doesn't want to exit. And in fact, a lot of these deal trophies behind me, in most of them, in fact, the CEOs are still there and are still working and are probably having more fun than when they were, completely independent, to put it that way. And the one that you're referencing of the performance agency out in Colorado is a great example of that. And so I met them actually through outreach, where I reached out to the CEO, which we do fairly often. We've completed, I would say, a dozen or so transactions over the last 3 or 4 years, specifically in the digital marketing and performance marketing space. So, we know the difference between companies. We know the difference between, recurring revenue, between performance, between affiliate, between digital marketing and all those things. And so we have a very good sense of where a specific capability set will fit in to a transaction that perhaps a larger buyer or private equity group is looking for.
I want to talk about the reach out process, because I think that's a little bit, you'll correct me if I'm wrong, atypical.
Yeah, it is. And so let me give you an example. We're going to close a transaction here at the end of this week. And this is a client that does email marketing, very specific. And when we closed on this transaction, we had 3 offers for his business. And he picked the one that was most exciting to him. He got a nice chunk of cash at close. He got a nice chunk of equity in a larger company that will probably have a much bigger exit in a few years. And so there are 2 other companies that I would consider to be very good buyers that were not successful acquiring this business, but are good companies in the space that need email marketing, that want email marketing. And now I have a pretty good vision into how they'll structure a deal. So as we view it, that's half of a ticket. So we look for the other half. And so again, it's different from calling a guy and saying, hey, will you sell your business, right? But most of the companies that we work for are guys that are in the lower middle market or somewhere between $1 million and $1.3 million in EBITDA, right? Maybe $1.4 million. And so, as I tell them all the time, the path from $1 million of EBITDA to $5 million of EBITDA is a very well-worn path, right? Lots of companies have gone down this road. It is not a straight road, right? And it is not an easy road. But if you want to go do that on your own, then absolutely you should, and we'll support you in any way that we can. But as an alternative to that, where the things that you need, maybe more salespeople, maybe more service lines, maybe more infrastructure, more support, you can plug into all of those things and take chips off the table. And most likely, when you exit, you'll do so at a bigger exit multiple. Those things become compelling if you like the people and the vision and the company that you're joining. And so in the case of the email marketing firm, there's two other great buyers out there. And so what I find is that if we knock on enough doors and present that opportunity, very clearly not an opportunity to exit the business, but more so evolve their business and become an important contributor in something larger, that resonates a lot with entrepreneurs.
Yeah. So Todd, you're saying if someone gets a reach out message from you, they should respond quickly because you have the other half of the ticket for them. And it's a reach out because you may see from your research that there is potential there in your network of potential buyers.
I mean, 100%. And so two things I find. Number one, my timing is not their timing. Sometimes people just don't want to do it. Sometimes people are very content continuing to do it on their own, getting to a point that they want to. And certainly that's fine. But when we spend time and learn enough about what that other person wants to accomplish, what that entrepreneur or CEO really wants to do with their business, I have conversations with strategic buyers and private equity groups and others probably 5 or 6 or 7 times a week. And so when somebody tells me and they hear of a transaction or some of the ones that we've done, and they say, geez, a transaction like that would really be interesting for me if you ever found the right fit for that. That's what all of these are behind me. And I've got another board over here because we'll take usually about an hour to really understand somebody's business and debrief well enough so that I can keep my eyes open for
exactly what they're looking for.
And that's kind of how this performance agency in Colorado happened.
I want to stick on this for 1 second, Todd, about you said the word more fun. And so I want to clarify what that means, because I think, a lot of times when people think about, at least me too, like selling your business one day, we think about exiting and not staying there. But a lot of the people like what they do. And correct me if I'm wrong, but it sounds like it's a place for them and they can kind of just focus on what they like doing and what their skill set is and still be a part of the larger company and serve that purpose. Is that accurate, or how would you fill in the blanks there?
That's definitely accurate. As you grow your business, and everybody listening to this knows this is true, there's just more and more and more complexity in the business. And guys and women, they yearn for the day when it was just a small shop and they can control everything. And so if you can get back to simplifying a lot of things, it is much, much more difficult to run a $5 million business than it is to run a $50 million business. Because in a $50 million business, you have a CFO, you have a head of HR, you have a controller, you have a head of sales, and these are quality people, right? Because you've got a big budget, you can afford all this. In a $5 million company, that's all of it's you, right? And it becomes a real challenge. And growing, like I said, that road is a well-worn path, but it is not straight. It's a hard road from that standpoint, right? Yeah. So that's the trick. It becomes more fun, I find, because they've gotten rid of a bunch of the stuff they don't like to do. They're thinking and acting on a bigger stage, if you will. And they've got a bunch of zeros in their bank account now, right? Because there was real cash, real liquidity at close. And that also seems to add to people's enjoyment in life, right?
I love it. So this performance marketing company, you reached out to them. Mm-hmm. What happened next? So here's an example. So, I'd done a couple of transactions earlier in the year, performance agencies. And
there, again, a lot of activity in the space, reached out to this gentleman, and he and his partner had been running the business for 10 years. They were about $1.8 million or so of EBITDA on right around 10 million of revenue. And so we talked some, and I told him about the transactions that we had completed over the last year or so.
What was their initial response, Todd? So like you reached out to them.
Yeah.
Were they like, is this for real? Or did they try, did they engage with you right away?
Yeah, it's interesting. More and more, those are just fishing expeditions, I think, for a lot of people, and entrepreneurs pick up on that some. So sometimes there's cynicism initially up front, and we try to, let people know that this is our space and we've done a bunch of stuff in the digital marketing space before. But to your point is interesting, Jeremy. I said to him, here's the last few transactions we've done, and here is the EBITDA multiple and the percentage of cash at close. And he said to me, yeah, I'm not sure those numbers are accurate. I said, no. These are deals we've actually done. He said, yeah, those numbers just don't ring true to me. And he's a wonderful guy. I said, geez, man, where is this coming from? He said, well, to be honest with you, we went through a process last year with a much bigger bank than you. Now, a much bigger bank than you is code for somebody way better than you are, right? So, and the best offer we got was 5 times EBITDA, 50% cash at close, 4-year earnout. I said, listen, I don't know who you're talking to, but that's not where the market is.
So some of the deals you were showing him, what was it showing?
Well, I'll tell you, the deal that we closed, he got 7.25 times EBITDA. He got 70% cash in close at close. He actually got, I think, 60% cash at close and 10% 1 year later on a very simple earnout where he just had to maintain revenues. And then he got 40% of the new company. Right. Wow. So he was thrilled. Now, to follow up on that story, over last summer of 2020, during COVID, they acquired 2 other agencies, roughly about $5.5 million of EBITDA. So that business in March of 21 has a trailing 12 months EBITDA of $9 million. And they're on budget for 21 to do $11 million of EBITDA. And I would say a business like that, that's over 10 million, is probably 12 or 13 or 14 times on EBITDA. Now, from the acquisitions, they've got $25-ish million in debt. And my guy's been diluted down to about 24, 25%. But he's got a quarter of $100 million net value enterprise. And maybe the most important part of the story is that he and his partner, since we closed that deal in November of 2019, they have been doing exactly the same thing that they've been doing for the 10 years prior, right? They're taking care of customers. They're solving client problems. They're maintaining culture, recruiting new employees. They're doing all the stuff. But now they have a partner that's thinking at a different level on how do we build this thing into an enterprise where somebody will pay 15 plus times on EBITDA. And that is just a lot more fun for him. He's loving that entire experience.
So in the initial, you basically said, here's some of the deals we've done, and it almost seemed too good compared to what he had experienced a little bit of.
Right. And it's because of the other transaction from the much bigger bank. And I see this a bit. I see this often where small, lower middle market entrepreneurs think, geez, if this big investment bank will work with us, that'll be great. And it's not that I'm that much better than this other bank. We just did the work. And as I told him, I've been doing the work to sell your business for the last year and a half before we've ever met. I've been developing relationships. I've closed transactions. I know we did a transaction last summer where I brought that private equity group a really good opportunity earlier in the year, and they just couldn't do it because their portfolio company had recently done a transaction, right? So you got to know the timing of groups and who's looking for what and things of that nature.
Yeah. So, okay, you reach out, you engage with this company, what are some of the common questions they ask you in the very beginning?
Yeah, so that's great because the first question is, what's the multiple? What's my company worth? That's always a big one, right? And one of the things that we try to help clients with is what we would call true price discovery. And you get true price discovery because you'll have like this email marketing firm. We got 3 offers for that business, all of them about the same value. However, he liked the group that he picked and the mix and the amount of equity he could get, and he liked all those dynamics, right? So oftentimes on lower middle market deals, value of my company seems to be the first question. Very quickly, as they start to understand it, structure, the amount of cash up front, those things are critical. And then, what does somebody need me to do, right? As I always joke, the entrepreneurs I work for, they don't want to join the mothership and then fill out TPS reports and be an assistant to the general manager of the mid-Atlantic area or the mountain states or whatever it is, doing meetings 4 or 5 hours a day, right? But, we'll be closing a different deal this week. These guys have 400 customers and they need the capability set that my client has, right? Which is local SEO services. All he has to do is fish in that barrel for the next 2 or 3 or 4 years. He'll get all of his earnout. This company will be more valuable. He'll probably have more fun because his biggest challenge is always, how do we continue to bring in?
Where's the next customer
Exactly.
coming from?
Exactly.
So you have this initial conversation with the performance marketing company. You answer some of these questions. You do the true price discovery. Yeah. And what's the next step?
So in this particular instance, my client knew exactly what he wanted, which was, I want a fair value. He said to me, the right value for my business is 7x. He knew that because of what he went through with this other bank, right? Although they didn't deliver on that valuation. So he knew that, but he also knew he wanted to own a significant piece of the business going forward. And he didn't want to be part of a big group that was dipping down small and on from that standpoint. So there was a group in Boston, a private equity group in Boston, that's a smaller private equity group. They've got about $100 million of committed capital. They had decided that they wanted to be in the digital marketing space, and this would be their first investment there. That put my guy in a real good position, and kind of on from there. So the fit was great. And one of the things I talk to clients about oftentimes, for him, a typical private equity investment will go anywhere from, let's call it 4 to 7 years. So he's in at ground zero. He's going to be there for 4, 5, 7 years, whatever that is. And so if they acquire another business in November of 19, they'll be 2 years into their journey. Whoever joins then will still get a lot of uplift in the equity that they roll forward. Not as much as the ground zero guys, but they're also not going to be in it for 5 years. They might be in it for 3 years, right? And then there's other folks where I know there's a group that we're working on a transaction with in Chicago. They want to sell next summer. They are already high teens in terms of EBITDA. So when they exit, if we were to do this transaction that we're working on, my guys will get whatever it is, 70% cash at close. The 30% they roll forward, they'll get out of it probably next summer. So within 12 months, they'll be 100% liquid.
Hence the name of the show, Todd's Second Bite. Do you find that in that situation, are people's second bite? Well, all of you explain what second bite is. People listening to the show, probably most of them know what it is, but in case they don't, but do you find that actually sometimes the second bite could be more than what they sold the company for?
Oh yeah, the answer is yes. That's everybody's intent. And most often, and I could rattle off a handful of examples where if you look at the guy in San Diego, not San Diego, in Colorado, he got high single-digit millions cash at close when he sold 70%. The amount he rolled forward today is probably worth 20 or 25 million. So the smaller piece is worth 3 times the larger piece. And the most important thing about that, Jeremy, he didn't use any of his money to fund the transactions, to hire the additional salespeople that they've hired, to do any of those things. And as my client has said, I am certainly happy to reinvest their money in everything we need to grow this agency, right? It's just a lot harder when it's our own money. That's tricky.
So for people who don't know, second bite.
So the second bite is in almost any services business, in digital performance marketing, the same thing. You're not going to get 100% value for your company in cash at close. We've done a couple transactions where they got 100% at close, and a chunk of it is cash, the biggest chunk, and then a chunk of it's equity in the combined new company. What we sell that for in the future is the second bite. We've also done transactions where our clients get paid on their performance over the next 2 or 3 years and the improvement in that performance over the next 2 or 3 years. And that second bite is in a more narrow range. So it's not going to be 3 or 4 times the amount that they got up front, but it will oftentimes hopefully be more than what they had anticipated it being.
Do you find that it's more common to get that second bite when you're dealing with private equity? Because I imagine some agencies may sell to maybe a smaller agency and not to kind of a private equity backed. Is there a difference? Do you find differences there? Because you're playing in a little different universe, I think.
Yeah, it is a different universe. Smaller agencies, when they try to come together and there's not cash involved, I find those don't work much. We don't work on those too often. If there's private equity money behind it, you get the rigor and the sophistication and the infrastructure that's needed by a larger buyer. So you're sure of that second bite. There's also plenty of cash, so I can really get cashed out with real liquidity in the multi-million dollars at the time of close.
Talk about, so you have the initial discussion, you're kind of educating them on the true value. You go through, you're finding kind of a good match or matches for them to choose from. What's something to note about when they're going to negotiate?
Yeah. So a couple of really good points here. So when we win because from LOI to deal close, from a signed LOI to deal close is 60 days, 75 days is pretty standard, right? You got to go through quality of earnings and legal due diligence, financial due diligence. It is really, really critical that when you sign an LOI, that buyer has to be high-fiving themselves and each other in their office. It has to be a huge win for them because you're going to get bumps in the road when you go through due diligence. The financials are not going to turn. It's very time consuming to go through due diligence. And usually your revenues might soften a little bit during that period of time, what have you. What I don't want is that buyer coming back and saying, well, geez, I didn't realize this would happen. I didn't realize that would happen. I didn't realize they had this much recurring. I didn't realize that their top 10 customers had this much revenue, whatever the case may be. I want to be in a position to say, it's interesting because the other 2 buyers weren't concerned about that at all. So if you think it's a problem, just let me know. So that is the pressure that we lean on these guys against all the way through the due diligence process, because they're obviously much larger. They're oftentimes more sophisticated if they're private equity with a bunch of experience. And if you don't have something to push back against, they'll oftentimes, at least the opportunity will exist for them to take back some of what was so important that we got at LOI stage.
Nice. Yeah. Having options, right? Is important.
Having options is critical because of what I just said, number one. And number two, it becomes a lot easier. For example, for somebody listening, if I said, hey, would you sell your business for X amount? They would probably struggle over, is that a good deal or not a good deal, whatever the case may be. If I said to them, here's 3 offers for your business, which one do you like the best? Then you get clarity if they're all tightly bunched in terms of what the offer is. At least we know here's 3 intelligent, sophisticated people in the space. They all think my company's worth the same. Ergo, that's what my company's worth. These guys are willing to pay me all of it at close. And of all of it, I get 70% in cash and 30% in stock. These guys will pay me 75%, but there is no stock. I have to earn out the rest. I like this fit better. I believe these guys will be worth a lot in the future, whatever the case may be.
So we've taken this performance marketing company from the reach out to the discovery to, getting deals to the negotiation and then the outcome, which you mentioned as well. Are there any other interesting stories about the journey with this company on their path to selling?
Yeah, there's so much nuance in it that every time I go through it, the client says, wow, I just didn't realize there was this much to get a deal done. It's hard to get a deal done. And you touched on it earlier. The very, very best transactions are a win for both sides because right after close, there is no both sides. There's just us, right? And so as part of that, the kind of tricky dynamic is we want to negotiate really hard. And then you have to show up on Monday and work with these guys, right? So you got to have that buffer in between because you don't want bad blood to exist. You don't want any of those things when you're charging hard for what it is that you want to do next. And we have to negotiate your employment agreement. We have to a non-compete agreement, a non-solicit agreement. I mean, there's multiple parts of the agreement and there's little nuance to all of those that, depending on the future circumstance, could become really important.
What are some big mistakes people make in this process?
I would say this, the biggest mistake is to not have certainty and comfort over the deal that you want to do. And that from either having experience or using somebody with experience, right? Number one, there are, and we just, we could talk for another hour on this, but there's ways to structure the equity portion of a deal that can be very favorable or not. There's different classes of shares, preferred versus non-preferred. There's some things that are standard that the private equity guys get, some things that are non-standard, but they'll try to get. There's certain things that are reasonable in your employment agreement. When can they terminate you? How can they terminate you? For cause, for you to terminate for good reason. And none of these in and of themselves are a big deal unless they happen to you. And
it's so, like surgery, minor surgery. It's minor surgery is happening on someone else, not yourself.
Exactly correct. So there's 100 opportunities for little mistakes. Hopefully they are little mistakes. Finding the right buyer up front and positioning yourself with multiple LOIs or interested buyers makes all of that a lot smoother. All of it. Because when the fit is really, really good and the buyer, for example, is happening with this email marketing company, our EBITDA has softened a little bit during the underwriting process. They feel like that they've overpaid and probably have a little bit. But for the size that the buyer is and the size that my guy is, the overpayment versus what they'll do together in the future, not enough to worry about.
Yeah. It's like because it's a strategic buyer, then they're going to just get a lot more business off the bat anyways. It sounds like
they absolutely are. And there's enough real cash in there and enough experience on the buyer's side to say, we'll eat it. We're not going to retrade the deal. You're kind of close enough. And in good faith, we want to move forward because there's more value that we can create together moving forward more quickly than to try to, squeeze you down by 5% of the deal. And those are really good buyers.
Todd, I'm looking forward to more episodes. Everyone should check out more episodes of the podcast. There's going to be
we've got some great guests coming up. Some people that have actually walked through this.
Yeah, you're going to, basically chat with a lot of different people about doing deals. And then you're going to, people should check out your episodes where you're going to walk through more information. So I want to point people to check out more episodes of the podcast. They can email you if they have questions, and they can go to PotomacBusinessCapital.com. Are there any other places online or anywhere else we should point people towards?
PotomacBusinessCapital.com is a good one. I'm on LinkedIn. I can be found there and reached out there. So, all the standard stuff.
All right. Thanks, everyone. Thanks, Todd.
Thank you, Jeremy. It was great.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.